Hi everyone, I'm Rick Bensignor. Today is Tuesday, December 13th, and welcome to this week's In the Know Trader Show. Well, what I want to talk about as we think about what we're going to discuss in the trader education portion is the idea of comparing news and market turns. And we'll take a look at that today because it may be actually relevant for today's price action and potentially what comes forward. And then I want to follow up from last week where I was hoping to get to our ETF focus on the 11 SPDR macro sectors, but because I went deeper into the proper way of how to draw a trend line, and in fact, if you haven't seen that video from last week, I really recommend that you do watch it. I got really nice feedback from lots of people on it who said they did not know the minor details, but significant ones on how to properly draw a trend line and then how to interpret them. So make sure you watch last week's show too. But today, the trader education portion will be a shorter one, but one that I think is important for you to know. And then we'll go take a look at the 11 ETFs and what they're showing us. At In the Know Trader, we have 3 products for you. 2 are written. One is not. So let's start off with the written products. We have a weekly ETF tactical trader report, generally comes out on Thursday evenings, does a deep dive across all the markets that are the most important ones that influence the stock market. So each week we take a look into the US 10-year Treasury bond market. We look at it through generally the rate picture via the TNX, the yield chart of the US 10-year. We'll look at the US dollar index, and that's been hugely significant this year. So we do a pretty good dive into that and what I expect from the dollar. And that's hugely important because these days the dollar has been virtually inverse to what goes on in the stock market. So when the dollar rallies, it's not good for stocks. When the dollar comes off, it has been good for stocks. So that has kind of been the biggest driver this year of stock direction is the dollar. So we tell you what I think about the dollar each and every week, as well as the key levels there. We'll take a look at the gold market, often credit spreads, which in most years, not so much this year, but generally credit spreads are the precursor to stock movement. So if we see what goes on in the credit market, we can often figure out what is going to happen on the stock side. And then the most important of it all is a deep dive into the S&P 500. That's, and then of course, each week I give you a brand new ETF trading idea, as well as take you step by step through every open position we have on until we close that position. So I kind of hold your hand through an entire trade, start to finish, and to try to maximize the returns on those. That is the weekly ETF Tactical Trader Report. Our second report that we publish, it comes out just once a month on the last day of the month. It is our 7-11 report. The goal of this report is to outperform the S&P by being in no more than 7 of the 11 SPDR macro sectors. In other words, energy, technology, industrials, communication services, healthcare, etc. There are 11 sectors in the market. Combined, they make up the return of the S&P 500. What we do is max out at 7 of the 11 sectors that we hold via their ETFs, and we are crushing the returns of the market this year. Through November 30th, we are outperforming the S&P by 5.46% this year. We've outperformed 10 of 11 months, and we are completely, and just so you are clear on this, we are fully invested in the stock market at all times. We're just not fully invested across the entire stock market, right? We're choosing 7 of the 11 sectors to be in. And by being out of those that underperform and hurt the market, we have collectively been able to outperform by 5.46% this year. And in the 28-month history since we started this report in August of 2020, we are outperforming by 11.64%. These are phenomenal results in the money management industry. To beat the S&P while being fully invested in the market is done by very few players. This would definitely put us in the top 10% of all people benchmarked to the S&P. This year, I would wager that it puts us in the top 5% of all money managers out there. This 11.6% return in just over 2 years, better than the S&P, is honestly as solid as you could possibly find anywhere. If you want to subscribe to my YouTube channel that you're likely watching this on now, go to youtube.com/InTheKnowTrader, click on the subscribe button, and also click on, I think there's a little bell, and that will give you a notification each time that I put up a new video. And I occasionally tweet on Twitter, so my handle is InTheKnowTrader, so follow me on that. Okay, let's get back to here, comparing news and market turns. And I specifically wanted to take a look at this because today is such a big news day. It's the day the November CPI got released here in December. And of course, the market's flying. And let's take a look here at a chart. I want to go back a little bit in time. So in mid-October, the CPI number came out, and notice that we had taken out the September low just by a hair, and obviously had a very strong day. So if you look at the day before, the market had what's known in Japanese candle terms as a doji. It's even the open and close were the same price. So we had a large gap down that then turned around on a massive news day in the sense of the number first was looked at bearishly with the large gap down, and then buyers came back in and brought the market to close virtually on the high of the day in a very significant turnaround that then started this whole bullish leg that we're still in the midst of. So this came on the same type of news day as we have now on Tuesday, December 13th. It was a CPI figure that started out very bearishly, that turned around and closed very strongly, and then made its way well higher. And if we see what's, since then, we come to today. And what do we notice about today? Well, today made a slightly higher high to the move on a large gap up on what is perceived to be good news. But the way this is trading, look where we opened. If you know Japanese candles, you know a dark cloud. The top of the rectangle is where the market opened. The bottom of the rectangle is the close, or in this case, the market's still open, the current price, and then the normal highs and lows are the kind of wicks on either side. So yesterday, you can see we opened higher relative to the prior day's close. We opened higher, basically the low of the day, and pretty much closed very close to the high of the day. Today, we're doing the opposite. And what I'm noticing is this was a bad news day that the market ended up taking very bullishly. Look what we have now, a perceived good news day that we're, halfway. It is now, as I record this, 11:43 in the morning Eastern time. So we're a couple hours into the session, and we've already significantly faded. I'm not saying it has to happen, but today could end up being the exact opposite. Good news taken by investors significantly gapped the market higher, the same way the bad news back in October significantly gapped the market lower. That low took out the prior low for the move, only to turn around, significantly start a whole move. I'm saying it could very well happen again now. Tomorrow is the Fed rate hike as well as the press conference. And of course, what is, I'm thinking, given the market's reaction to the news, that they are obviously taking this very bullishly, it's very possible that Fed Chairman Powell tough talks the market tomorrow. The higher the market goes now, the more difficult time the Fed has in kind of accomplishing what they want to do. And without them wanting to be outright bearish the market, they actually don't want to see asset prices rising in an inflationary period. They'd like to see them cool down. So if he tough talks the market on Wednesday, you could see this disappear, and we could have kind of a similar situation where the news, the perceived bad news at the time that the low was made, turned around to end up bullish the market. We could have the very same thing happen today and tomorrow, that the good news of a low CPI number, lower than expected, what they call these numbers a cool number or a cold number as compared to a hot number. A hot number is now when the number comes in higher than expected. We could see the exact opposite. So I just wanted to point out to you and for you to realize that often news that you would think the market should react to in a certain way ends up being the opposite direction, and often the extreme opposite direction to a move, such that this market actually bottomed on bad news. You think of, intuitively, you think that, good news should make a market move up. Well, in this case, bad news made the market ultimately move higher. And here we had good news, and we almost have the mirror image. So I thought that was interesting for you to know and pay attention to, that it's often bad news that bottoms a market and good news that tops a market. This is not the only time this has happened. This is just in the most recent times, but it's often the case that bad news is what bottoms a market, and good news is what puts in the top. And today seems to be setting up for that, at least midday. I could be wrong by today's close, depends on where we close today. But I'm kind of looking at this and thinking we could very well have taken out a whole bunch of shorts this morning, brought in new longs, only to see, at least for what appears now to be smart money selling, with the likelihood that this could be the top of the move. So wanted to pass that along to you. Let's now move on to just looking at what the market's telling us in general by going through the 11 sectors of the market. So we'll go one by one through these 11 macro sector ETFs. These are all outright charts, meaning that they are in absolute terms. They are not relative to the S&P. So this is not about outperformance or underperformance, just the chart themselves and what we see. So here's materials, been on a tear since also early October, is now, this is real time, potentially stalling into a very narrow cloud, still holding its uptrend line. But we did make a new high for the move today relative to a couple of weeks ago. It's pulled back. Too early to determine if this trend line is going to break or not. But it's not as if there's no resistance here. It is running into resistance against its cloud resistance. We came from beneath the cloud, so this is looked at as resistance. What this may have a different look at compared to some of the other ones we're going to look is just how narrow the cloud is, such that it's a lot easier to pass through a narrow cloud than, let's say, if we had come from, in the past and had to deal with a very thick cloud like it was back here, where, the market really have to keep pushing and pushing and pushing to come out the top end. Here, it's not so hard to come out the top end because it's so narrow. The bottom and the top are so close to each other. Nonetheless, there is some resistance here. We have made a new high for the move and pulled back, so too early to tell, but if this trend line breaks, then we're probably heading down towards, at least, from the current almost 83, I could say that we've got a 5% move coming on the downside if the trend line breaks. That's XLB. We're going to go through these in alphabetical order. So next is XLC, Communication Services. The two big names in this ETF are Meta, the old Facebook, and the two Googles, GOOG and GOOGL, now of course called Alphabet. We are right now stuck in between the cloud's conversion line, that support here, resistance up at 52.5 or so. So not much here that I can tell. Too early yet to really establish that we have an uptrend going. This is still a rally, and obviously what's been a longer term downtrend. If we take a trend line, let's see, we are still well beneath the downtrend line from this year's highs, whereas the S&P played with it last week and played with it again, or 2 weeks ago, and played with it again today. This is still well beneath, and of course this has been one of the worst sectors to look at. So too early to really determine what to do here, but I'd say I'm more inclined to lean towards buying this on a pullback to maybe 48.5 or so, and then seeing if we can get above 52.5. If it does, you should get a move up to almost 59. And if you bought it there, you'd have to risk to a new low before you got out. There's not much really in between. XLE is next alphabetically. That is, of course, the energy sector, the star performer this year, outperforming the S&P by, something like 55%. Still well up on the year compared to the market, which is down. You can see here's January, that's April, here's January here. So, we came into this year, this trading in the low 60s. It's now in the mid 80s. Certainly the shining star this year after years of it terribly underperforming. But of concern, of course, is the sequential 13 count right near the highs of the year's pullback has now gotten beneath the conversion line. Important support is going to be near just north of the baseline. So let's call that anywhere from 80 to about $80 or so is going to be important support. Last sell-off in September, notice the bottom was the cloud. So now cloud support moves up to 77 and change or so going into the new year. XLF financials, next on tap. Notice here on an outright basis, somewhere both from these lows here, let's remove that and just draw it again. So we're in and around some resistance. This is the breakdown point to this rounded top. We then do a double bottom. This is kind of no man's land where it's at. Just in relative to its prior price action. But notice here too that you have a bullish propulsion momentum level at 35.64, which, although having broken above, it still has not been properly broken above. If we close this Friday above that level, it's a potential start, but you're going to have to also get above the cloud. Which unrelatedly to that happens to be close by at 36.13. So you need to see multiple Friday closes above 36.13 that then hold roughly $36 in order to think that this has done all the work it's going to do on the downside and can start reestablishing a base of which to move higher from. Otherwise, this is more possibly a sell on rally, like we're seeing here, resistance up against the cloud. Multiple Friday closes beneath 33.47 would be negative, but right now this is pretty darn neutral, stuck in almost precisely in the middle of the range that we've had going back to, let's call it May of 2021. So no real advantage in playing this right now. And if anything, I'm more a seller than a buyer because of the difficulty that it's facing against the cloud. XLI Industrials has broken through its cloud lagging line, has not been able to yet. So what you really want to see, the more closes, Friday closes that we can get, let's just use this week's current high, which is probably today's high, as the more weeks we can close above 103, 103 and a half or so, the better chance this has to go and then take out the highs. Until it does that, from a risk reward point of view, being that we're trading at 101, you only have to risk $2 or $3. It's actually probably a better sale than it is a buy right now, simply because of, look, this rally in here stalled not only against the propulsion level, but where the lagging line hit the top of the cloud. We then sell down to make a new low this year. We've now taken out that high, which means you've run some buy stops against that high, only to see it stall where it is. I'm more in the camp that this may very well pull back right now, having already squeezed out the shorts. XLK Technology, not a good performer this year. Pretty much topped right near the beginning of this year, had a sequential 13 on the top, sold off, eventually made a 13 a couple of weeks before the bottom, has started a decent recovery, but again, even this week, and again, this spike up is going to be this morning's high, failing against the bullish propulsion level of 140.2. So it needs multiple weekly closes above that in order to suggest that this can further rally. Notice again, the August high failed against the bullish propulsion level, happened to be the cloud bottom too. Here we're not so different, failing against the bullish propulsion level and not far from the cloud bottom. So tech not out of the woods yet. And as much as bulls want to tell you that this is good, today's price action is not. In fact, when we started this webinar, not that many minutes ago, the S&P was close to up, where futures were up about, what did I see? They were at 40.80. They're now at 40.56. So we've dropped 25 points. That's 0.5% just while we're talking here, in line with what I'm saying, that today could end up being the failure, the exact mirror image of the October bottom. Okay, so tech, after techs come Staples. Staples, one of the better charts. Not only has price gotten through its cloud, but the lagging line has gotten through its cloud. So this is one of the most bullish charts. We're still stalling kind of against the August highs. We're on an 8 towards a 9. The last 9 count was a bottom. The 9 count before that was right near a bottom for an up move. So we could be getting closer to a top. But I do like Staples in the sense that, it's a very defensive part of the market, and I am far less bullish than many people are of the market. And I do think we're going to have a tough beginning. And if I'm even right on thinking that today's price action could have topped the market, then not only do we not get a Santa Claus rally, but it could be a very weak end of the year leading right into the beginning of next year, which I would suspect would continue along those themes. XLRE real estate comes next. So these are REITs, and we have same thing. Look, baseline resistance, that's the orange colored line from the cloud model. Also failing against the bullish propulsion level. This is the second time in the last 3 weeks that we can't get above 39. What is that? It's just about $40. Now, today's only Tuesday. We still have a Fed meeting to come. So certainly we have a lot more price action to go for the balance of the week. But as of right now, we are still stalling where I expect resistance. And so first support could possibly be this pink line, the conversion line, coming back down at 36, let's call that 37. And then the next level is 35.24. I could take a downtrend line, but that's very steep. Let's take a look at the secondary trend line, which we're still underneath and would need to push through in order to have any chance to get to the cloud. So this is a bounce in what I think is an overall bearish market. It's stalling where I'd expect it to. I'm not buying REITs here or now. What comes next? Utilities, XLU. Utilities also one of the better charts in the sense that price has gotten above its cloud. The lagging line is above its cloud. But similar to staples, we're on a week 8 towards a 9. So a possible we saw the last time it was a 9. It was the high of the move. So that could happen again next week before it pulls back. Don't forget, something like any of these defensive sectors, staples, utilities, if the whole market goes down, these names are going down too. They're just not going to go down as much. So generally, I'm still leaning towards those that have better charts where they've, let's say, broken through. Price has broken through clouds, lagging lines have broken through clouds, making these bullish than the ones that are still being capped by their clouds. XLV comes next. That's healthcare, and healthcare is now on its 9 count. So it's been strong enough that it's actually kind of a week ahead of some of the other ones. So now we have essentially, let's go back to December of last year, a potential triple top. This was the high. This was a slightly higher high in April of this year, but still a failure there along with a 13 count. And now we have a 9 count. It's kind of trouble. This really needs to, this ETF, which is trading at 140 and small change, needs to get above 144.64 on multiple Friday closes in order to think that it really has more to go. I like healthcare as a defensive sector. It's done obviously very well and is closer to its all-time high compared to anything else we've looked at so far. But we have the potential here for this to fade from this triple high with a 9 count. And again, it may be a sector to be in as far as relative performance, but on an outright basis, not a bad place to potentially be taking some profits. And then what do we have? We have one left, XLY, consumer discretionary. I mean, take a look at this chart versus what we just looked at in healthcare. Healthcare's above its cloud, lagging lines above. We're up against all-time highs in healthcare, and take a look at this chart. You're not far from this year's lows. Totally different picture. Much, much weaker. I'm not in this sector, and this one's tough to pick. There's no one bottom here. Let's see. In fact, if we go back to September of 2020, we kind of have the general support level. We can call it anywhere from, this zone with these dark purple lines is the important support here. And you'll see, even though this is not considered a head and shoulders pattern because it's not a topping pattern, but there's definitely a left shoulder here. There's a head, and there's somewhat maybe a sense of a right-hand shoulder. But again, not a topping pattern because it's not at the top of a move. This has actually been how it's trading in a down move, which could very well set up for a further down move. Now, failed head and shoulders patterns often go straight in the opposite direction, whether it's a standard head and shoulders or an inverted one. But again, right now, here and now, I'm not terribly enthused with a chart that looks like this. Has been such a dog in performance this year, and has massive overhead resistance. Now, there's still plenty of room to get to if it was going to get there, but you'd really have to be convinced that the market's going higher in order to, and that we're not going to have a recession in order to want to go into consumer discretionary type names. What are the two biggest holdings in XLY? It's Amazon and Tesla. Tesla's stock has obviously had troubles ever since Elon Musk went and bought Twitter, and Amazon unfortunately hasn't been able to go anywhere. Still in the upper 80s, and if you do a 20-to-1 split, which it had done, upper 80s, even if we called it 90, is the equivalent of 1800, and that's half of its all-time high. So even a company as solid as Amazon is 50% off its all-time high. So that's the look here, and clearly a much weaker chart. That's it for this week. I hope you enjoyed the show. I hope you get the some valuable information too about looking how the market interprets news, and when you get the gap up like you did today and then a straight sell down, that could easily be marking a near-term high. So I'm kind of leaning that way. Too early to tell until we see what the Fed does tomorrow, but that's the way I'm leaning. Alrighty, we will see you next week. Thank you for tuning in to In the Know Trader. I'm Rick Benn, Sr.